Where to invest today, April 12, 2025. In an unpredictable world, one question remains constant for anyone serious about building wealth. Where should you invest your money right now? As of April 12, 2025, the global economic landscape is full of challenges and opportunities. But there's one dominant theme shaping everything: the rise of new tariffs, the expansion of geopolitical conflicts, and the return of global trade wars. From the United States to China, from Gaza to Ukraine, and from the Red Sea to European capitals, nations are recalibrating their priorities. Trade, security, and resource control are once again central to policy and to investment strategy. From a fund manager or chief strategist's perspective, this is a macro regime shift. We are no longer in a cycle of rate-driven market behavior. We are in an era of structural realignment. The global economy is fragmenting into regional blocks, and with that fragmentation comes mispricing, risk repricing, and opportunity, but only for those who can reallocate with precision and purpose. Markets are reacting with extreme sensitivity to each of these developments. Every new tariff, every missile strike, and every diplomatic fracture is now instantly priced into commodities, equities, and currency markets. The volatility index, VIX, has climbed steadily over the past 3 months, driven by uncertainties around US-China trade tensions, rising energy prices due to Middle East instability, and fluctuating food prices impacted by shipping disruptions. Equities, when decomposed by sector and region, show high dispersion. Defense stocks have rallied sharply. Lockheed Martin, LMT, is up 18% YTD, Northrop Grumman, NOC, has gained 15%, and Rheinmetall AG, RHM, DA, is up over 22%. Cybersecurity firms like CrowdStrike, CRWD, and Palo Alto Networks, PanW, have outperformed the Nasdaq, rising 24% and 19% respectively. This reflects a sectoral rotation into real assets and government-aligned industries. Meanwhile, consumer discretionary names like Nike, NKE, which rely heavily on Chinese manufacturing and demand, are down 11% YTD. Luxury brands such as LVMH and Richemont have reported slowing sales in Asia-Pacific. Industrial companies with unhedged global exposure, including Caterpillar, CAT, are under pressure. Commodities have outperformed most asset classes YTD. Gold is up 13.2%, silver by 8.9%. Brent crude has traded in a volatile range but remains above $90, with traders pricing in ongoing Red Sea disruptions and Iranian tensions. Copper is up 10.5%, while lithium carbonate prices are recovering from 2024 lows, with expectations of demand rebound from battery manufacturers. Fixed income markets are bifurcated. U.S. 10-year Treasury yields fell to 3.75% in March, as safe haven demand surged. Investment-grade credit spreads remain stable, but high-yield spreads widened by 45 basis points in Q1, particularly among exporters and energy-intensive industries. In Asia, spreads on South Korean and Taiwanese exporters have increased 50 to 60 basis points, reflecting China-linked risk. Currency markets show clear macro themes. The US dollar index, DXY, is at 106.2. The Australian dollar, AUD, has gained 3.4% YTD, benefiting from resource exports. The Canadian dollar, CAD, is flat, as oil price strength is offset by housing market fragility. The euro, EUR, has weakened to 1.06, affected by sluggish growth and energy insecurity. The Chinese yuan, CNY, is under managed depreciation pressure, while the Japanese yen, JPY, continues to weaken despite 2 BOJ interventions. So, what's the strategy? From a capital allocation standpoint, this environment calls for a barbell approach. On one end, hold core defensive assets that protect against macro shocks. 1. Strategic commodities. SPDR Gold Shares, GLD, Global X Copper Miners ETF, COPX, and Lithium Americas Corp, LAC. 2. Short duration, inflation-linked government bonds, iShares TIPS Bond ETF, TIP, Schwab Short-Term U.S. Treasury ETF, SHO. 3. Exposure to commodity-linked currencies, AUD via Invesco Currency Shares Australian Dollar Trust, FXA. On the other end, selectively embrace risk where structural tailwinds exist. 1. AI infrastructure and chips. NVIDIA, NVDA, Advanced Micro Devices, AMD, Taiwan Semiconductor Manufacturing Co. TSM. 2. Cybersecurity. CrowdStrike, CRWD, Palo Alto Networks, PANW, Scalar, ZS. 3. Defense contractors. Lockheed Martin, LMT, RTX Corp. RTX, BAE Systems, BAESY. 4. Blockchain platforms. Ethereum-based L2s, e.g. Polygon, tokenized asset networks, Chainlink, Avalanche subnets. 5. Rights. Prologis, PLD, in logistics, Digital Realty Trust, DLR, in data centers, and Welltower, in healthcare, void or underweight. 1. Consumer discretionary stocks with high China exposure. Nike, NKE, Apple, AAPL, supply chain risk. 2. Tech manufacturing exposed to cross-border export controls. 3. Office rights with urban exposure and high vacancy. SL Green Realty, SLG, Vornado Realty Trust, VNO, implement a tactical 3 to 9 month phased allocation. Monitor. 1. US CPI, PPI, and FOMC guidance. 2. EU trade and carbon border adjustment mechanisms. 3. Chinese industrial subsidies and capital controls. 4. Middle East energy corridor stability. 5. Q1 and Q2 earnings across AI, defense, logistics, and rights. This is not a trader's market. It is a strategist's environment. Capital must be mobile, thesis-driven, and backed by cross-asset validation. Those who align portfolio construction with macro-regime dynamics, not media narratives, will outperform. If you found this information useful, consider supporting our work. Subscribe to the channel and turn on the notification bell, so you never miss an update. We release new videos every week with clear, practical insights into finance, investing, and technology. Leave a like if this content helped you, and share it with someone who wants to make smarter decisions with their money. Let's grow and learn together. Your future starts now. Disclaimer. This video is for educational and informational purposes only. It is not intended as financial advice. Always consult with a certified financial advisor before making any investment decisions. The creators of this content are not responsible for any financial outcomes related to the information presented.